Fed Chair Jerome Powell and other top officials have emphasized a wait-and-see approach when it comes to policy, closely monitoring employment data and only considering rate cuts if the labor market further deteriorates. Well, guess what? It's finally starting to happen. U.S. non-farm payrolls rose by only 22,000 in August, which is well below the 75,000 that was expected, and that $79,000 print from last month, well, it was actually revised down to just 73,000. And with that, we saw the unemployment rate advance to 4.3% from 4.2% in July, which is the highest mark since 2021. All of that to say that this was a weak employment report. And if that wasn't enough, the people who applied for unemployment benefits ending August 30th rose by 8,000 to 237,000, which means jobless claims is now sitting at the highest level that we've seen since June, adding additional concerns to the labor market. And because of all of this weakness on the employment front, we actually saw Treasury yields fall as the bond market is now projecting 100% odds of a rate cut coming on September 17th. In fact, if you look at this chart here, there's an 88% chance of a 25 basis point cut and 12% chance of a 50 basis point cut. So what does all of this mean? Well, in layman terms, weaker job numbers prompt investors to buy bonds. When investors buy bonds, the price of those bonds actually goes up. And here's the best part. When bond prices go up, interest rates go down. Now, at the time we're filming this video, mortgage rates are sitting at the lowest level that we've seen in the last 11 months. And that's because last year at this time, we were pretty much having the same conversation leading into the Fed meeting. So what's the biggest difference between this year and last year when we saw interest rates hit the lowest level in 2024? Well, to be completely honest, the employment market was a lot stronger. Inflation wasn't quite as stable. And you had a lot of people front running the Fed, expecting the Fed to cut rates aggressively. And that's one reason we saw the 10-year drop so much last year, leading into that Fed meeting, only to see interest rates shoot back up after the Fed made the decision to cut rates. Now with that, there's something I'm hearing a lot of at the moment, and that's people saying, hey, I'm waiting on the Fed to cut rates in September because interest rates are going to go even lower. At that time, I'm going to refinance. At that time, I'm going to purchase a home. But here's the reality. The rate cut that's going to happen on September 17th is already baked into the cake from the probability numbers you saw earlier, which means when the Fed does actually cut rates on September 17th, you're not likely to see interest rates really drop any further. With that, I think there's something really important to note that I've pointed out several times over the years of filming this video, and that's that the Fed doesn't control mortgage rates. They have an indirect impact on mortgage rates, but when the Fed actually cuts rates, that just cuts the rate that banks borrow money from one another, in addition to cutting the shorter end of the yield curve. So it does impact things like credit cards and car payments and even student loans, but it rarely impacts 30-year mortgage rate. At the moment, Fannie Mae is expecting mortgage rates to end 2025 at 6.5%. Now that's up from 6.4% last month. But here's the thing, they're only expecting mortgage rates to drop to 6% by the end of 2026. So you can see, even with all of the talk out there about Fed cutting rates, about employment data weakening, Fannie Mae still doesn't see a market where interest rates are going to drop aggressively. But in my opinion, here's where I think they're wrong. Now, while I don't necessarily agree with Fannie Mae's forecast, as I believe there's an opportunity for interest rates to actually move lower than what they're predicting here, I also don't think you can sit on the sidelines and try to pick the top or the bottom in mortgage rates. Last year, around this same exact time, we saw a lot of people that were in a position to refinance. A lot of people that were ready to lock in their interest rate, just waiting, thinking, I'm going to wait even further because interest rates are declining and they're finally starting to move down. So I'm just going to wait until that trend continues, until it makes even more sense, only to see mortgage rates move back up. And a lot of people missed out on that opportunity. Now, fortunately, I was able to take advantage of it. I watch mortgage rates every single day. And because I was currently sitting in an interest rate higher than what I really wanted on my mortgage, I was watching rates aggressively. And as I saw interest rates hit the lows last year, I called my lender and had him lock in that interest rate at that day, which was 6%, which was a 0.5% better than I was. It saved me around $400 to $450 per month by doing that refinance. Now, I could have waited for an opportunity for interest rates to move down and save even more. But here's the thing, I was happy with the $450. Plus, I was able to do a no-cost refinance, so it wasn't costing me any money. I took a slightly higher interest rate than the best interest rate on that day. The lender gave me a credit back to cover my closing costs, So I was able to refinance with no cost and save a significant amount of money per month. So my suggestion is, if you're currently under contract on new construction or in escrow on a house, or maybe you're in a position to refinance if interest rates move lower or even sit where they are today, then I would take advantage of it as the opportunity presents itself. Ring the cash register. You'll always have the opportunity to do it again in the future, assuming you can qualify. But here's the thing. What if you can't qualify in the future? What if you lose your job? What if your home price actually goes down and you're no longer in a position to take advantage of it where you could have at a previous time? Now, with that said, I don't think you should run out and buy down an interest rate. I don't think you should pay a bunch of fees to refinance or buy a house by getting a certain interest rate. So when you're going through that process, just make sure you're working with a professional, somebody that can guide you, somebody that's answering your question, showing you side-by-side comparisons where it ultimately makes sense. Now, if you'd like to work with our team, we help a lot of people here on YouTube. There's a link in the description of the video. Now, just a moment ago, I mentioned how I don't necessarily agree with Fannie Mae's forecast. They're expecting mortgage rates to end 2025 somewhere around 6.5%, which is actually higher than where we are today. They're also expecting interest rates to end 2026 somewhere around 6%. But here's the thing. Inflation looks to be getting under control. The employment data is starting to weaken, and we know the Fed has a dual mandate. One is price stability. The other is maximum employment. At the time we're filming this video, Trueflation is showing inflation just over 2%, which is exactly where the Fed wants to see it. Now, this is a little bit different measure of CPI and PCE because that data isn't real time. Trueflation is a measurement where they're taking in all of the information that's currently coming in, and they're telling you where inflation is today based on all of that information, whereas some of the measurements that the Fed's using are a bit outdated in my opinion. So with that said, we got inflation sitting at 2%. We got unemployment going up, which means the Fed is likely going to have to start to stimulate the economy by cutting the Fed funds rate. As they start to cut that Fed funds rate, one thing is going to happen. The spread between the 30-year fixed and the 10-year note is likely to improve. Now, if we go back and look at historical averages, it averages somewhere between 1.5 and 2%. Let's just say 1.7%. Well, in 2024, it was over 2.5%, but as of today, it's sitting somewhere around 2.31%. So as that spread compresses, it's going to allow mortgage rates to come down in and of itself. In addition to that, if we see further weakness, investors start to buy bonds, well, that likely means that the 10-year note is also going to improve. So if we can get a spread closer to 2% and the 10-year coming down to say 3.8%, then that means we can have mortgage rates in the high 5. Now, this isn't something I think is going to happen tomorrow, but I think over the next quarter, the next 2 quarters, as the economy continues to weaken, you're likely going to see mortgage rates continue to grind lower. On top of that, we now have Treasury Secretary Scott Bessent starting to interview for the new Fed chair once Jerome Powell exits. And based on Polymarket, Chris Waller is the highest probability. But at the end of the day, why should we care? Now, we know that Trump wants lower rates. He's actually come out and said that interest rates should be about 3% lower than where they are today, which essentially means he wants a Fed chair that has the same views as him. And as of today, Chris Waller is in that camp with comments like, we should cut at the next meeting. We don't need to follow a lockstep sequence of rate cuts. We could see multiple cuts, whether every meeting or every other. Yes, we'll have a blip in inflation, but it won't be permanent. And we can always adjust the pace of rate cuts. Now, I don't know about you, but this is exactly what Trump is likely wanting to hear. And maybe that's why Waller's saying it. But on top of Waller, you have Kugler exiting, which means Trump gets to pick a nominee to fill her spot. In addition to that, you have Cook on the hot seat over mortgage fraud, so there's a chance that she's going to be gone, and Trump's also going to get to fill that spot, which means out of the 12 voting members, Trump has an opportunity to pick 25% of them over the next couple of months. But why should home buyers care? Well, in the short term, this could impact mortgage rates in an aggressive way. Not necessarily the long end of the curve like the 30-year fixed mortgage, but it could impact things like adjustable rate. But at the moment, it's a wait and see approach. So if you're a home buyer sitting on the sidelines, someone that already owns a property trying to refinance, take advantage of the opportunities when they present themselves. Stop trying to pick the top or the bottom in the market. Call a mortgage professional. You can speak with us directly using that link in the description and have the conversation. If you're sitting on the sidelines waiting to get pre-approved until interest rates come down so that then you know, that's the wrong approach. Do the pre-approval now, have an idea of where you are, and then as interest rates come down, call your mortgage professional back, find out what the new payments are, find out what your new qualifications are based on those rates moving down. Waiting only puts you behind the 8 ball. But here's my question to you. Where do you think mortgage rates are actually headed? Do me a favor and let me know in the comments. Lastly, I appreciate you watching. I appreciate the support. If you found any value, make sure you hit that thumbs up and subscribe to the channel.